Welcome to our deep dive into Ethiopia's financial system. We've got a stack of recent articles from Fortune, and let me tell you, things are getting interesting over there.
Interesting might be an understatement. From a brand new stock exchange to a struggling cot trade, Ethiopia's financial landscape is experiencing some serious shifts.
Right. So we're going to go beyond the headlines today and really unpack what's happening in Ethiopia's financial world.
Absolutely. And to kick things off, let's dive into the National Bank of Ethiopia's latest report. It paints a picture of growth.
Yes.
But also some pretty significant vulnerabilities in the banking sector.
Okay, so the report highlights a lot of operational risks. It mentions fraud losses hitting 1.3 billion birr. That's a QGE number.
It is. And what's concerning is the variety of fraudulent activities. We're not just talking about basic scams, but also sophisticated social engineering schemes. And good old-fashioned embezzlement. Even dormant accounts are being targeted.
So what does this level of fraud signal about the overall security of the Ethiopian banking system?
Well, it raises some serious concerns. Remember, these breaches erode trust. And if people start losing faith in their banks, that can have ripple effects throughout the entire economy.
It makes sense. The report also mentions internal risks, like employees under financial pressure who might be more likely to engage in unethical behavior. What can banks do to address this human element?
That's a great question. It's a balancing act. Banks need to implement robust background checks and training programs focused on fraud prevention, but they also need to create a supportive environment for their employees. Things like employee assistance programs could be valuable in this regard.
So it's not just about catching the bad guys, but also fostering a culture of compliance and ethics within the banks themselves.
Exactly. And along with fraud, the report also flags liquidity as a major concern. Imagine this. If the top depositors in 20 of Ethiopia's 29 banks decided to withdraw their money, those banks wouldn't meet the regulatory requirements.
Whoa, that sounds like a recipe for a financial crisis. Why are these banks facing such a liquidity?
Well, Ethiopia's economic growth has been slowing down, and that can impact banks' ability to generate revenue and maintain those liquidity levels. The report also points to the concentration of deposits in certain areas, which can make some banks more susceptible to sudden withdrawals.
I'm thinking about what happened with Nib Bank. They recently went through a major leadership shakeup. Due to mismanagement and liquidity shortfalls, it shows this isn't just a hypothetical risk.
It's a very real risk.
Yeah.
And it underscores the interconnectedness of the financial system. If one bank struggles, it can impact the confidence in others and potentially trigger a domino effect.
Okay. So we've got fraud and liquidity concerns, but the report does highlight some positive developments in credit distribution, right?
Yes. There's been a shift away from concentrating loans in the hands of a few big borrowers. Credit is becoming more accessible to a wider range of businesses, which is a good sign.
So it's a mixed bag for the Ethiopian banking sector. Signs of improvement, but also some underlying vulnerabilities that need to be addressed.
Exactly. And that's why this deep dive is so important. We're going beyond the headlines to understand the nuances, the potential risks, and the opportunities within Ethiopia's financial system.
Now let's move on to something that really caught my attention, the cot trade. I was surprised to see it described as being in crisis. Isn't cot a major cash crop for Ethiopia?
Is, or at least it was. What's happening now is a perfect storm of challenges. Unauthorized checkpoints, increasing costs for exporters, rising taxes, and a surge in contraband trade.
A triple whammy, as they say. And the report really highlights the human cost of this crisis. Farmers are seeing their prices plummet, and some are being forced to abandon their livelihoods. It's pretty heartbreaking.
It is. And the situation in Somalia, which is once Ethiopia's biggest cot market, is particularly striking. They doubled the tax on cot imports, hoping to generate more revenue.
So what happened? Did it work?
It completely backfired. Daily shipments plummeted because legal traders couldn't compete, and now illegal cot is flowing freely across the border.
So the legitimate trade is being squeezed from both sides. Higher costs in Ethiopia and shrinking markets abroad. It puts Ethiopian cot farmers in an incredibly tough position.
Yes. And even the cot trade with Djibouti is facing difficulties because the quality is being affected by all these checkpoints and delays. It's a classic case of unintended consequences.
The report tells the story of a farmer named Jamal Dubey who supports his family of 7 on his cot farm. He's getting half the price he got last year. It really brings home the impact of this crisis.
It does. And it raises an important question. Can Ethiopia find a way to regain its competitive edge in the cot trade without sacrificing the livelihoods of its farmers?
Well, the report explores some options, like streamlining regulations, cracking down on contraband, and even investing in infrastructure to support the legitimate cot trade. They're also talking about finding new markets beyond the Horn of Africa.
It's a complex issue, but what's important is that the government is acknowledging the urgency of the situation and seems to be exploring solutions.
Now let's move on to something a bit more upbeat. Ethiopia is finally getting its first real stock exchange.
Yes, the Ethiopian Securities Exchange, or ESX, is set to go live soon. It's a significant development that has the potential to reshape Ethiopia's financial landscape.
It sounds like they're doing everything by the book. They've got their licenses, raised capital, and even partnered with a global tech firm for their trading platform.
They've been working on this for years, and it seems like they're determined to get it right. They've established a comprehensive regulatory framework, set listing requirements, and are actively promoting the ESX to potential investors.
Okay, so what does this mean for everyday Ethiopians? How will having a stock exchange impact their lives?
Well, the goal is to create a more vibrant and transparent capital market in Ethiopia. The ESX will allow companies to raise capital by issuing shares, and it will give everyday Ethiopians a platform to invest in those companies.
So it's about opening up investment opportunities and giving people a chance to participate in the growth of their own economy. Could this attract more foreign investment into Ethiopia as well?
Absolutely. And it's not just about big corporations. The ESX will have a growth market specifically designed for smaller, high-growth companies.
Yeah.
This could be a game changer for startups and entrepreneurs looking for funding.
This is where it gets really interesting for me. The articles mentioned that some big state-owned enterprises, like Ethio Telecom and Ethiopian Airlines, are expected to list on the ESX. What kind of impact could that have?
It's definitely a bold move. It could attract a lot of attention and potentially signal that Ethiopia is serious about opening up its economy. However, it also raises some questions about transparency and potential conflicts of interest.
I see what you mean. Will these state-owned enterprises be subject to the same level of scrutiny and regulations as private companies?
That remains to be seen, and it's something investors will be watching closely. The success of the ESX will depend on building trust and confidence in the market, and that includes ensuring a level playing field for all participants.
Now let's shift our focus to one of the major players in Ethiopia's banking sector, Bank of Abyssinia. Their recent financial results show a mix of positive and concerning trends.
Yes. What's immediately striking is their turnaround in foreign exchange activities. They went from a loss last year to a substantial profit this year.
That's impressive. But the articles also point to shrinking profit margins and rising costs. How are they reconciling those two realities?
Well, it's a classic case of balancing growth and profitability. They've been aggressively expanding, opening a significant number of new branches.
67 new branches last year alone, according to the report. That's a lot of expansion.
It is. And while that's contributed to their deposit growth, it's also added to their operating expenses. They're also facing rising costs for wages and administrative expenses.
So it seems like they're betting on the long game, investing in expansion now and hoping it will pay off in the future. But as we've seen, there's a lot of uncertainty in the Ethiopian economy. It could be a risky move.
It definitely carries some risk. But they're also making strategic moves to offset those rising costs, like focusing on high-yielding products and services.
They're also investing heavily in digital technology, particularly virtual banking. Is that a sign of them trying to adapt to a changing landscape?
It seems like they're recognizing the need to adapt. Digital banking allows them to reach more customers without the overhead of physical branches. It aligns with a global trend we're seeing in the financial sector.
The report quotes their president, Zakaluz Zilike, emphasizing the importance of digital transformation and cost reduction as key priorities for the coming year.
It sounds like they're taking a multi-pronged approach, expanding their reach, diversifying their revenue streams, and embracing digital technology. It'll be interesting to see how these strategies play out in the long run.
Especially given all the other factors at play in Ethiopia's financial system right now.
Exactly. From the cot trade to the stock exchange to the challenges facing individual banks. There are a lot of moving parts. And that's what makes this deep dive so valuable. We're not just looking at individual pieces, but trying to understand how they all fit together.
It's like a giant puzzle, isn't it? All these different pieces of the financial system interlocking and influencing each other.
Precisely. And speaking of puzzles, let's zoom back out to the bigger picture and look at this shift to an interest-based monetary policy framework in Ethiopia. This is a big deal.
The report definitely highlighted that, but to be honest, I found this part a little confusing. Can you break it down for me? What exactly does an interest-based monetary policy framework entail?
Certainly. In simple terms, it means that the central bank uses tools like interest rates and open market operations, basically buying and selling government bonds, to influence the supply of money in the economy and manage inflation.
So instead of relying on things like administrative controls and fixed exchange rates, they're using market mechanisms to manage the financial system.
Exactly. It's a move toward a more market-oriented approach, which, in theory, should create more stability and predictability.
It sounds like a pretty significant shift. Are there any challenges associated with this new system?
Well, one challenge they're facing is the persistent gap between the official exchange rate and the parallel market rate. It's a common problem in economies undergoing this kind of transition.
And that gap can create all sorts of distortions.
Yeah, it can. But the fact that the central bank is actively managing the exchange rate and intervening in the market suggests they're committed to minimizing these distortions and working towards a unified exchange rate system.
The articles did mention that foreign exchange transactions have been increasing since these reforms were introduced. It seems like a sign that things are moving in the right direction.
It does. And it's important to remember that these kinds of transitions take time. It's about building credibility, attracting foreign investment, and ultimately fostering sustainable economic growth.
Speaking of sectors closely tied to the financial system, the report also touches on the capital goods leasing subsector.
Ah, yes. The leasing sector. They're facing some headwinds, particularly those firms heavily reliant on the manufacturing sector, which has been hit hard by the economic slowdown.
The report mentions the risks associated with the dominance of government-affiliated leasing firms. What are those risks?
Well, if there's a shock in the banking sector, say a sudden increase in bad loans, it could easily spill over into the leasing sector, especially if those leasing firms are heavily reliant on banks for funding.
It's like that domino effect we talked about earlier.
Exactly. And the report does highlight one leasing company, Oromia Capital Goods Finance, which is taking proactive steps to mitigate these risks.
By diversifying their portfolio.
Right. Moving away from the struggling manufacturing sector and looking for opportunities in other areas.
Precisely. They're recognizing the need to adapt and spread their risk. It's a smart strategy in a volatile economic environment.
And that seems to be a recurring theme in this deep dive. From individual banks to entire sectors, everyone is trying to navigate these shifting financial currents and position themselves for long-term success. It's a fascinating dance, isn't it? Trying to balance growth and profitability, manage risk, and adapt to new technologies and regulations.
And we haven't even touched on the pharmaceutical industry yet. I was struck by the report's description of Ethiopia's healthcare system grappling with chronic medicine shortages.
It's a critical issue, and it highlights how interconnected the financial system is with every aspect of society. If the financial system isn't functioning effectively, it can have ripple effects on everything, including access to essential healthcare.
The report talked about a major overhaul of the drug procurement process. Can you tell me more about that? What are they trying to change?
Well, currently, the Ethiopian Pharmaceutical Supply Service, or EPSS, is responsible for procuring and distributing medicines. But it seems like they've been hampered by bureaucratic hurdles and a lack of autonomy.
So they're essentially trying to streamline the procurement process?
Right. The proposed directive aims to give the EPSS more flexibility and authority to respond to urgent needs, and hopefully ensure a more reliable supply of essential medicines.
But it's not just about efficiency. The report also mentions a push to support local pharmaceutical manufacturers. How does that fit into the equation?
That's where the financial aspect comes into play. There's a proposal to allow domestic manufacturers to quote their prices in foreign currency, which they argue would put them on a more level playing field with foreign suppliers.
So it's about trying to boost local production and reduce reliance on imports.
Exactly. But it also comes with its own set of challenges. Many local manufacturers struggle with capacity constraints, raw material shortages, and limited access to investment for research and development.
It seems like a classic dilemma, trying to support local industry while also ensuring a consistent and affordable supply of quality medicines.
It's a delicate balancing act. And the report doesn't shy away from the impact these shortages are having on patients and healthcare providers. They quote a hospital director who says his facility can only meet about half of its drug needs with its current budget.
That's a powerful reminder that these aren't just abstract policy debates. These decisions have real-world consequences for people's health and well-being.
Absolutely, and it underscores the importance of a healthy and well-functioning financial system. If the financial system is struggling, it can impact everything from access to healthcare to the ability of businesses to thrive and create jobs.
Now, shifting gears back to the new stock exchange, the report mentions some skepticism about its potential for success. Given Ethiopia's economic and political realities, are those concerns valid?
Well, there are certainly challenges, and those concerns shouldn't be dismissed. One key challenge will be attracting investors and building trust in the market. Ethiopia's history of state-dominated economic policies could make some investors hesitant.
That makes sense. And the fact that state-owned enterprises are planning to list on the exchange raises questions about transparency and potential conflicts of interest, as we discussed earlier.
Exactly. But the potential benefits of a well-functioning stock exchange are significant. It could attract foreign investment, boost domestic savings and investment, and create a more transparent and efficient capital market.
The report quoted a financial advisor who emphasized the importance of public awareness and education about the stock market. If people don't understand how it works, or feel confident that the rules are fair, it's unlikely to succeed.
It's a valid point. Building a successful stock exchange is a long-term project that requires a concerted effort from everyone involved: the government, regulators, and market participants.
Okay, so we've covered a lot of ground here. From the banking sector's vulnerabilities to the complexities of the cotton trade, from the potential of the new stock exchange to the challenges facing the pharmaceutical industry. We've delved into some fascinating facets of Ethiopia's financial system.
It's been a truly insightful deep dive, and I think it's clear that Ethiopia's financial landscape is anything but static. It's dynamic, interconnected, and constantly evolving. Thanks for joining us. We hope you enjoyed the journey and maybe learned a thing or two.
It's been a pleasure.
Until next time, keep exploring, keep questioning, and keep diving deep.